right, Mark Newton, Newton Advisors, guys. This is a huge treat. I'm a huge fan of Mark for a long, long time. So Mark, do your thing. Don't let me stop you.
Thanks, buddy. No, I appreciate it. Thanks, JC, and I really appreciate you guys extending me the invite to be part of this second Chart Summit. It's great to join this all-star cast, of course, brought about by JC Peretz, none other of the all-star charts. So thanks very much. I wanted to, for those of you who don't know me, first of all, I've been involved with technical analysis really since the early 90s. I've been on the buy and the sell side of the field of finance for about 25 years. I worked with Morgan Stanley. I did a stint with Diamondback Capital Management, and I used to be a CBOE trader back in the late 90s, my past life. So I really think that I bring a pretty complete field of a lot of different kinds of technical analysis and try to blend together a lot of different approaches. And so today, at least initially, I want to discuss a few different things. And so initially, the use of relative charts, time frame analysis, and multi-asset study, I think a lot of people just look at specific charts of what they're concentrating on, and I really think it's important to broaden the perspective and really draw in charts from many different asset classes to really help you improve your timing and whatever you're looking at. So initially, I just want to give sort of a boring overview and a backdrop. As we all know, this could be called the last flight to Pamplona. I think obviously the running of the bulls is an understatement. We've had one of the biggest economic expansions of all time, and the rally has just been unprecedented. Everybody has been talking about records day in and day out of how we haven't even had a 3% drawdown, a 5% drawdown. We continue to set records. And so things have definitely changed over the last couple of years. And we're going from an era of very angry times, marches, concerns about Trump speak and or what could happen with the Fed and this and that. The bottom line is that when you use technical analysis, none of this stuff really matters. And if you use a ruler and simply look at things from 2009, we've been in an uptrend, and it really has paid to ignore all this other noise for quite some time. But the bottom line is that we're truly in an unprecedented time. We've gone from a period of very low volatility over the last couple of years to recently one where we've had a very parabolic move to the upside in a short period of time. And so I think that, many people are sort of scratching their heads and wondering what's next. I will really concentrate initially on relative charts. I think this really is one of the more important points of technical analysis, and utilizing this to really help people make decisions on sector rotation, on how to use stock relative strength, not only versus the peers, which stock is better than the other stock, but really also style shifts, and is it a good time to be in growth? Is it a good time to be in value? Outside of that, time frame analysis is important, putting things into perspective. It's great that a stock goes from 50 to 70 in a short period of time. Well, is it time to buy or is it time to sell? I think you have to utilize the longer term perspective on weekly and monthly charts to help put this into perspective. And finally, we'll talk about multi-asset study, and by that I mean, looking at several different things, not just stocks. If you use technicals on treasury yields, on currencies, on commodities, a lot of the times these assets and what they're telling you can help you make better decisions on the stock that you're looking at or whatever asset you're looking at. So without further ado, let's take a look at relative analysis and how I use technical analysis quite frequently. And so many people that follow me on Twitter or know of my work know that I do a lot of relative work. And this is an example of energy and really specifically the XLE. And so what's interesting is that you saw breakouts in energy on a relative basis far before you saw breakouts on the XLE or OIH last year. And so a lot of this occurred in the early part of September. And so it's interesting and useful to take relative charts, take ratio charts of certain things, that being XLE versus the S&P. You can see that the breakout happened. It was pretty pronounced, and this happened coinciding with those that used the mark really right at the lows of late August in the XLE. Energy had been the worst performing sector of last year, and it went quickly to being one of the best performing sectors over the last couple months. And so a lot of this can be mean reversion, but simply it just pays to watch some of these long-term trends it's not necessary to be a rocket scientist or understand algorithms or know how to back test to a certain extent, as long as you can concentrate on keeping it simple and studying these downtrends and uptrends. And if things are trending or if they're sideways, oftentimes that can mean all the data that you need in the world to make intelligent decisions about whether to buy, sell, or hold. So initially we see that energy had broken out, and that has actually continued. That's been a great trade. Energy has actually followed suit on what's happened with crude that really got a head start, and then energy followed suit. When you look at healthcare on the other side of things, you saw that healthcare had broken down substantially back in August, really between August and October of last year. And so we had a big period of underperformance that all of a sudden bottomed out. And in the last month, we've seen that start to gradually get stronger and stronger. And so this breakout happened really in the second week of January. Now, around that same time, you saw breakouts in biotechs, you saw the breakout in the drug stocks. And so, it's really important to take a look at how healthcare lines up. And currently, this still suggests that healthcare has a way to go in terms of relative performance. And so one should still be involved in this, still favor healthcare. I still like this sector, and it's really, for those of you that look at just absolute charts like the XLV, it really helps to put everything in perspective. But that obviously broke out quite a long time ago, back in June of last year. But, on a longer term basis, we see the healthcare has been choppy over the last couple of years and really has underperformed in September. So I like looking at things on more of a short-term time frame and really trying to identify the sector rotation. And I think by utilizing some of these ratio charts, they can really allow you to do that. Next, we'll take a look at utilities. Now, this sector had really been under substantial amount of pressure since 2009. That's obviously when the stock market bottomed. I mean, its last serious bottom was in March of 2009. It had been trending down ever since. What I thought was interesting, though, is if you look at relative charts of the Utes versus the S&P, you saw nearly a 3 to 4 year sideways pattern where things were really not showing much of all that much sign of deterioration anymore. And then all of a sudden we see a big breakdown under recent lows of support. For me, that is really important, and that means that this sector really has started to turn much more negative just in the last couple months. Now, some of that obviously coincided with the Treasury yields starting to bottom out. Obviously, yields moving higher would be naturally thought to cause breakdowns in the utilities. But when you plan things in relative terms, this just helps to put the absolute charts into perspective. And so obviously Utes are really something that on an intermediate term basis should continue to be avoided. And if anything, if we get a short-term bounce in this group, then it's unlikely that we get back up through this trend line just because it was just broken last month. And so this has lasted for the last 4.5 years, the last 3.5 years. And so it would really take a move back up above this trend to think that the Utes all of a sudden are going to show a more important period of intermediate term strength. So right now they're clearly weak, and clearly the Utes and other defensive groups have been really hit by hard times, which started really the middle part of 2016. A lot of that really helped to drive the market higher to people who had gotten very, very skeptical. Technology, on the other hand, has also shown extraordinary amounts of strength last year. And so when you graph things in relative terms, be it the S&P Information Technology Index or even the XLK over the S&P will give you the same idea. And you'll see that, really technology had bottomed out back in 2002, but really it didn't really start to accelerate until 2013. This is when it bottomed last. But for those that wonder why technology truly outperformed the way it did over the last 12 to 18 months, you really have to look no further than to put things in relative perspective, and you see that technically you had a giant base in process from 2012 to 2016, and when this was broken out, this really allowed for that acceleration to happen, which a lot of people wouldn't know otherwise. And so you saw the breakout in the semiconductors, you saw the breakout in a lot of the hardware stocks, but really, relatively speaking, this oftentimes can help to add a lot of alpha in terms of finding out stocks and or sectors that are gradually starting to break out above former highs that oftentimes can cause that acceleration that will really aid a sector and show true amounts of relative strength. The next stock we'll take a look at is really a relationship between China and the U.S. And this is another way we use relative charts, is to look not only at stock versus stock or sector versus sector, but taking a look at countries themselves. So this is the liquid GXC versus the SPY. And so for those that aren't familiar, the GXC is the spider of the S&P China. And so we had that lengthy downtrend that really coincided exactly when commodities peaked back in 2011. So that lasted nearly 6 years, and all of a sudden we saw the breakout the middle part of last year. So despite the fact that the S&P has been strong, and many of us have a focus really on U.S. stocks, it's really been the move in emerging markets and the move in China itself, which has been really impressive since the middle part of last year. So this really helps to put into perspective what we see with regards to China versus the S&P. You saw the break of the longer-term trend line. Now we're approaching the flatter trend line just from the last 5 years. My thinking, as the dollar continues to accelerate, which I think should continue to happen in the years ahead, and we'll get into that a little bit later, that China really can continue to outperform, and really getting above these highs from late 2017 should continue to allow for outperformance there. So for those that are considering that the U.S. might be overpriced or overvalued or overbought technically and really want to get some exposure elsewhere, China certainly is an interesting area with regards to technically, given how dramatically it did underperform since 2011, and now it's gradually starting to finally show signs of strengthening. Another one is just looking at Europe, and most of us know that Europe has been a huge laggard to the U.S. over the years, and specifically really since 2014. So you see that dramatic downtrend. Well, that finally started to change the early half of last year, and I think of the cover of Barron's talked about Europe finally starting to gain favor, and of course that did work for a few months, but then again we topped out back in May of 2017. So interestingly enough, Europe has really not done a whole lot, relatively speaking, since last May, and so it's important to keep these into perspective. You can use anything for your ratio to represent Western Europe. I use the EZU just for the Eurozone stocks. I think that's a good basket. It's a nice liquid basket. Some people would use the FEZ or the VEK or other things of that sort. But this truly shows that we did see a minor breakout that happened early last year, and that seems as of now to have stalled out. So the larger downtrend still in place. Europe right now is still very much a laggard. So we haven't seen enough to really suggest that Europe is truly starting to change and move higher. We've just seen that very briefly. The other one is just looking at the S&P versus the NASDAQ, and here shown as a ratio of the NASDAQ to the S&P shows that we had a fairly big period of outperformance that happened late last year. And so some people would pin that on the acceleration in the technology stocks and or healthcare, and both of those are correct, of course, but the NASDAQ really being comprised of large cap tech, oftentimes it is important for those that are looking for a market peak or looking to see when you see a change of trend. You want to see when you see an inflection in the NDX versus the S&P, and right now we certainly haven't seen that yet. We saw the breakout early last spring, and that provided for the acceleration, and that really is still ongoing. So the real key for those that are looking relatively is going to be, can this in fact make new highs? Can this get back up to former peaks that were made late last year, or do we start to turn down? And for me, it's important just to look at the trend from last summer. And so until this is broken, then it still is right to favor the NDX versus the S&P, still favor large cap tech. We have seen a little bit of weakness in the last couple weeks, obviously, in some of the bigger cap stocks like Apple. Some of the other ones have gotten extended, but we haven't really seen that breakdown, and so that's going to really be key to think that anything truly is starting to happen. I also like to use relative charts really in ratios of things like of credit, and so for many people they look at the JNK and that's great, but oftentimes when you look at ratios of things like the investment grade bond ETF, like the LQD versus the JNK, this can really give a good sense as to how credit spreads are doing, which in turn will give you a good sense as to whether the market is starting to show the supply is drying up in credit, and we start to see spreads widen, and oftentimes the downturn in credit will precede the downturn in equities. It doesn't always work vice versa, but oftentimes you'll see a widening out in credit before you'll see equity markets also start to turn down. So in this case, what this shows is that we did see a big breakout in the ratio of credit spreads, meaning that credit spreads are starting to widen back in late 2015. And so it's important to use ratio charts like this because this actually preceded the move down into the winter of 2016. As most know, we got a big sell-off into January, February of 2016, and it was approaching 10% or so from the peaks, and credit was a great gauge as to why this happened. It coincided really right at the same time. As you can see now, this collapsed ever since 2016. So you see the breakdown of this red trend line. That in turn indicated that credit spreads are starting to tighten a bit. And this actually coincided with the market, with the equity market rallying strongly up those lows. So right now we've seen a little bit of widening a bit just since the early part of last year, but it hasn't been all that dramatic. And so to really think that equity markets are going to be in a fair amount of stress, you really want to see this turn up pretty dramatically. And so having relative charts of the LQD versus the JNK is at least one piece of the puzzle. So obviously, a lot for those that are involved in credit know that you know, you really have to consider flows and the move of treasuries themselves and really the supply-demand cycle as to what's going on. And so there's a lot of different charts that can help you look at that. But this is just really a keep it simple, stupid chart that will help you to analyze relative spreads of credit. And it's not ideal, but it certainly does capture the times when credit is really starting to tighten and or widen pretty dramatically. The next one we'll take a look at is just developed markets versus emerging. And so this was interesting in that it really highlighted the peak of developed markets versus emerging back in the middle part of 2016. As most know, the dollar started to deteriorate pretty rapidly at the beginning of last year, and this coincided with emerging markets breaking out. And so conversely, when looking at things and developed markets versus emerging, this in fact broke down from this longer term uptrend as of really the middle part of last year. So this showed emerging market strength and or developed market weakness relative to emerging, and right now this still looks to have at least another month or two that it could pull back. So interestingly enough, you know, it's still right to be long emerging markets. Or for those that are looking at it the way this spread shows, you want to really favor or avoid overweighting developed versus emerging and thinking that developed are still going to underperform in the near term, which means that commodities still likely do well, emerging markets do well. China does relatively better than the U.S., and at least in the short run, that this ratio has a bit more to go. Now, you see these colors on the charts. I do utilize DeMark indicators with almost everything I do, and in relative charts, that's no different. And so right now, this is really a main way that I will utilize DeMark in a way that very few have done. And I do a lot of overlays in terms of putting his counter trend indicators, specifically TD sequential and TD combo, onto relative charts. And so right now, they're still very premature to show any sort of low at hand in this ratio, which means over the next few weeks that we're still likely to get a pullback in this. And so conversely, that means emerging markets still outperform. So the bottom line is that it's still right to be long EM. And if we see a turn in this, that will give us a lot to think that, okay, maybe it's time the dollar starts to rally or emerging markets sell off. For now, it still seems early. And so when using relative charts like this, I use combinations of this along with my analysis on the dollar, along with several other things to really come up with conclusions that emerging markets, at least for now, remain the place to be. Style shifts are another way of using relative charts, and so many people don't take the time to look at this as much as they should, and you hear stories about a lot of these value managers saying, oh, it was a really tough year last year, I don't know what happened, you know, I didn't think Trump would work out, and I'm a value manager, I'm not sure why value is underperforming, and it really only takes a couple different charts to put this into perspective and really show that, you know, growth right now is still the dominant theme, and this started right around the time of last election, last November, December, is when you see ratios of the S&P growth ETF starting to outperform the value ETF. And so you see that this was an uptrend really from 2013 till 16. The fears of the election or whatnot caused a little bit of a sell-off, and really it doesn't matter the reason. You see the break of this trend, and so you want to be in value for the most part of 2016. That turned in the early part of 2017. You see the breakout here in early 2017. So for those that look at the macro picture, you know, it doesn't really matter what the issue is. It doesn't matter what your thinking is of what should outperform based on your thoughts of the Fed or based on growth. Really all it takes is a couple charts to put this into perspective and really get a good understanding of just trend. And right now it's still very much right to be in growth. Now if we see things start to take out prior lows from late last year, we see 2017 lows broken from November, then that would say, well, value could be taking over and we could see a real outperformance of value stocks versus growth. But for right now it's still right to be in growth. Getting back to some of the sectors, you know, this is something that was interesting in taking a look at consumer discretionary versus the staples. And so you saw the big outperformance from 2009, and obviously after the first couple of years of QE, everybody knew that the discretionary should outperform. But what's interesting is when you put things in a relative basis, you oftentimes tend to see a lot of these predictable chart patterns that many of us learned in Edwards and McGee, that being, you know, cup and handle patterns. Well, this is none other than a large cup and handle that really started back in 2005. You see the cup and the handle really lasted about 2.5, 3 years, where we saw a lot of churning in this ratio, and then recently, in the middle part of last year, we saw that break out again. So for those that were skeptical on the market or bearish on stocks at the middle part of last summer going into the fall, you could see the dramatic outperformance in discretionary, that meaning the XLY, which obviously is heavily overweighted in Amazon, Home Depot, and a lot of those stocks. You knew it was right to be long those stocks, and you knew that until you really saw any sort of peak in this ratio of discretionary to staples, that it was still right to favor this theme that discretionary could outperform. Moving on, you take a look at the airlines, and the airlines obviously have come under a lot of pressure of late. We've heard about the fare wars and this and that. Well, if you look at relative charts, these can help you to see those kind of things in advance. You see things like the XAL relative to the transportation space. Now, this broke down really in the fall of last year, and so this actually gave many people an advance warning that airlines were due to start to underperform. Transports have been strong for some time, and then recently we've seen a little bit of a drop-off in the transports in the last couple of weeks, and a lot of that has been blamed on the airlines, and they're right to think that. But really, the airlines started to lose favor back in the middle part of last year. Now, this relative chart would really get you to agree that it's still right to be long other parts of transports versus the airlines. You still want to be underweight the airlines in the short run, and you can pin that on crude or whatever you want. I mean, everybody's got their reason as to why the airlines start to underperform or outperform, but the bottom line is that they had a lengthy period of outperformance, relatively speaking, and that looks to have changed. And now airlines all of a sudden are starting to dramatically underperform. So that's something to keep really in the front of your mind when you're looking at things, and charts like this really help to put things into perspective. The next we'll take a look at is just the chart of consumer staples themselves as a sector. And so we see when you graph things on a relative basis and going out a long period of time, you can see really how dramatically this began to underperform starting in the middle part of last year. And so I think this is important because, you know, many people had started to get bearish late last fall. Well, all of a sudden you saw a pretty dramatic pullback in this ratio. And so this was interesting in that it showed that staples all of a sudden started to really dramatically underperform, and it's still, that really coincided with a lot of this rip that we've seen in the market, is that the staples started to really fall on hard times. So this deterioration is something that oftentimes is important. You see this period of the rally back in 2007, 2008, that was when staples are showing very good signs of strength. So for those that are bearish, what you want to see is staples start to break these downtrends and start to meaningfully move over this longer term area of support. That would be a big sign that it's right to be long the staples. Now, we saw that on a very short-term charts a couple weeks ago, but really we want to see a break in the bigger downtrend just from 2016 and getting back over that to think staples are going to start to outperform.
Hey, Mark, on that note, if staples do start to outperform, that would probably coincide with a correction in equities, right? Would you not agree with that?
You're absolutely right, JC. Now, look, we've seen a little bit of stabilization in the utilities and staples, and that started 2 weeks ago. And so I came out with my piece to talk about the best staple stocks to buy because that group started to look interesting. And the defensive sectors in general have started to stabilize a bit.
Coca-Cola.
But the long-term basis, it's really important to note that these things are still under a lot of pressure. And so right now, any minor rally has got to do a lot to suggest that these things are really going to turn.
I think that's great. And what about with what people are saying? People are loving the presentation, by the way, Mark. They're like, "Oh my God, he's awesome! So nice work." But they're asking, with respects to higher interest rates. You know, people are, the rumor is that will affect tech stocks more than other sectors. Can you touch on that? Do you think that's right or no?
Well, you really have to put that into perspective and get a feel as to whether interest rates are truly going to start to rally. I mean, my thinking is we got to get over we have to get over January of 2014 highs to even have an inkling that rates are going to start to make a larger move and break the 30-year down cycle. So I don't agree with Guntlock. I think that rates in general have to go higher over the next dozen years. I'm just skeptical that it needs to happen right away. And so I've got a few charts. I'll try to zip through these a little quicker because we do have I have about 50 charts and we've gotten through half of them. I know that we have about 20 minutes left. And so
you got some time. Go ahead.
I'll touch on these real quick and then we can really tackle broader market themes at the end. Aerospace and defense is a subsector, so a lot of people have commented recently on industrials are stretched, transports are rolling over. Is this problematic? I think, absolutely it is. But one part that people haven't touched on is that look at what's happened with aerospace and defense. Now, we've seen the move already, and obviously Boeing, it's been a monster of late. General Dynamics, Northrop Grumman. However, look at charts of like Arconic or Rockwell Collins or TransDigm. These are just starting to play catch up. You can see the relative chart just pushing on to new highs. So this relative chart of aerospace and defense versus the entire industrial sector really helps to zero in on subsectors that can start to strengthen meaningfully. So despite maybe other sectors falling out of favor, this still suggests that aerospace and defense is really the right area to be right now. And it's just starting to break out as per the larger industrial sector. And some of that obviously is GE falling below 16, and that's falling on tough times. Myself as a Connecticut resident can relate, and I'm saddened to see them leave the state of Connecticut. But look, it's right now aerospace and defense is where you want to be. The banks versus the brokers, we saw tremendous underperformance when the regulations took hold after Dodd-Frank 2012 to 2014. The banks have stabilized. In the last couple months, this has started to turn up. So if we see the move back up above this red trend, that would mean it's right to favor the banks as opposed to the brokers. Right now, it's been pretty choppy, and if anything, in the last year, it's actually been better to be in the brokers for that last touch of the red trend line in early 2017. We've seen the Morgan Stanleys, the Goldman Sachses, the Interactive brokers. A lot of the brokers have outperformed, but that could be changing. So a break of the red trend would mean favor the banks as opposed to the brokers. Pharma versus biotech, yet another example. So pharma fell out of favor in the middle part of 2017, and biotech ever since then has just absolutely ripped to the upside. So for those trying to say, well, I'm not sure what part of healthcare to be in, a lot of times all it pays to do is just take a few relative charts, and you can certainly put this into perspective as to the best part of healthcare or any other sector to be in. Now, this is a really interesting chart for those that look at longer-term technicals, because this is a chart of the S&P Healthcare Equipment and Services Index versus pharma and biotech. So we all know that ever since Obamacare came out that it's been a boon to some of these service stocks and obviously the equipment makers, and we've seen a big period of outperformance to that. That looks like it actually is going to continue. So we just seen a breakout of the entire trend since 2006, which means that it's right to favor, Intuitive Surgical or Anthem or Cigna or UNH or Danaher. These are all leading stocks in the last 6 months as per the Equipment and Services Index. And right now, we've seen a breakout to all new all-time high territory, indicating that this likely is going to continue to outperform similarly as it's done in the last couple of years, and it likely is going to outperform pharma and biotech. Materials over Europe. So we've already talked about U.S. being better than Europe. Look at what's happening with the materials index. You look at the XLB over the SXOP. So for those that manage money abroad, you know that the Europe 600 construction materials is certainly one way to get exposure to that. But should you even really own it? Isn't it better to own the XLB? this chart would indicate that's absolutely the case. So you look at XLP, we've just gotten above the highs from last summer. It's a nice base breakout that we've seen that just happened a couple months ago. So those should really be long XLB to be short SXOP, and or find stocks to short abroad versus in the U.S., because the U.S. right now is still a big outperformer in that regard. Semiconductors versus hardware. Look at this base breakout. We saw this really since 2008 to 2015. This went nowhere. But when you look at relative charts, they show you these traditional classical chart patterns, like, you know, reverse head and shoulders patterns. Well, look at what happened to semiconductors, and this broke out in 2016. This sector absolutely ripped, and I think a lot of people really did not understand why this was happening. And a lot of this was just because in relative terms, you saw a lot of longer-term base breakouts in stocks like Intel and in a lot of these other semi-names where they've been basing for almost a dozen years. Relative charts are also great for stock by stock. Look at what happened between Apple and Facebook. So you see the trend that happened throughout the last couple of years. This is 2014 to 15, so you have to back up a bit. This is a historical chart. It's not current. So I took the time between 2014 to 16 to put this into perspective. But Apple had been outperforming Facebook for a lengthy period of time. But look what happened in mid-2015. So if you use relative charts like this, this can help to aid your absolute analysis when you're looking at stocks like Apple or Facebook, or which one do I prefer, which one to buy. And, you know, I do that with a lot of my institutional clients, and I work with some retail people as well. And you know, that's the kind of value that I like to add, is by looking at retail, looking at relative charts and how these things can aid. Commodities is another area. So this is interesting in looking at copper versus gold, and this just started to roll over late last year. So whether this is a sign of sudden weakness in the economy upcoming or not, I can't tell you that. I know that gold has been threatening the 1365.70 area, which would be a big breakout for gold. Obviously the dollar's pulled back. The ratio of copper to gold, though, looks to have broken a trend going back since 2016. So this does look to be at least a short-term negative for copper. When you look at gold versus the S&P, I am a gold bull. However, when you look at it versus the broader equity market, gold broke down late last year. So it's still right now to be long stocks versus gold, and or avoid gold relative to the stock market until we see signs of that relative trend being broken. So if we see that move back over that level, then I'm really on board with owning as much gold as you can as opposed to U.S. stocks. And obviously, given the uptrend in the equity market, we've seen the parabolic move, and so that's obviously moved much further to the upside than gold has of late, so that's what caused that breakdown. Relative charts with regards to crude spreads, this is another way to use it, and people talk about, you know, the supply factors or domestic production and this and that. Really, all you need to use is charts of Brent versus WTI, and this can aid you in choosing whether you want to be long whether you want to be long this spread or short this spread. And right now, it still looks like this spread is going to tighten up. That would mean that Brent and crude, which have gone from -6.5, should likely get to at least -4. And if they break that, then there's a good chance that they can continue to soften the difference between the two, and they'll continue to contract. Crude versus gold. This is another way of using relative charts. People say, well, crude's had a good move. I want to sell crude. I want to get involved in the metals. Well, potentially. This is something where if crude were to get above this prior peak versus gold, then crude likely is going to continue to outperform, and if anything, meaningfully. And so sometimes it's useful to look at these ratios. Everybody right now is focused on the metals, given the dollar declining. People have looked at crude, but it's definitely not as big of a focus in my mind as people looking at the metals. And so this is going to be sort of an inflection point, I think. If we start to turn down, we see signs of this uptrend from last August breaking, then, you know, that would be a chance to say, okay, you want to avoid crude, you definitely want to be long gold versus crude, and right now it's at an inflection. Bond yields, this is another area. So the ratio between bond yields and treasury yields are important to a lot of people. We did see those widen out pretty dramatically. You saw the downtrend intact in these spreads. We got to about last September. The breakout of that suggested that it was right to short treasuries, that treasury yields would start to move up versus bond yields. And that lasted up until about December. Recently, it's been more of in a range. So what's going to happen? Well, let the chart tell you that. We initially did see the break in December, but it's taken on more of a consolidation pattern. So a move back up through the highs means that crude or I'm sorry, the Treasury yields likely start to continue to move up at a faster pace than Bund yields, which means it's still right to short Treasuries and think that yields potentially climb up to near 280. Time frame analysis. So we'll cover this quickly. This is something I always like to do. I hear a lot of people looking at daily charts and they say, oh, look at Intel. It's gotten so overbought. I can't buy it here. And when you look at things from 2011 to 14, this puts the move in some of these stocks into perspective because it moved very quickly from 27 to 34. Was it time to sell it when they got to the right-hand side of that chart? Well, a lot of it depends on your time frame. It depends on your risk tolerance. When you look, it was right to sell it, at least initially, because it did go from 35 down to 30. You look back at that right-hand side of the chart. And why did it peak there? Well, you look at the peak back on the left. So we made a substantial high back there in 2004. Oftentimes, the first test of a prominent high like that can be important, and it's really important to use that long-term time frame. Go back as far as you can. See where the prior highs and lows are. People might argue they're different companies then. That doesn't matter. They oftentimes still tend to work. You'll find meaningful supply. You'll see selling when stocks get to those levels, and if it goes through it, then you'll see short covering and you see acceleration. But they're important to keep in mind, and this is just one example. So at that time, were you ready to sell Intel at that time? It got up to near 35. Well, look what happened. Look at the longer-term chart on a monthly basis of Intel since 2000. This thing broke out back in late 2014, back when many people thought it was overbought at 35. That was just the beginning of what happened to be a major, major breakout in semiconductor issues. So this longer-term perspective is really essential to technical analysis, and when you're utilizing a daily chart, for those that aren't day traders that look at things on more than one time frame, even if you're a 3 to 5 week position trader, you have to utilize the longer-term charts. Look at weekly charts, look at monthly charts. They help to put these things into perspective so you really gain an awareness. Here's another one, Microsoft. Was it right to sell it up here? The stock on the right-hand side, it looks sort of toppy, right? Well, this is back from 2016 to 17. It made a quick move from 56 to 72. Myself, looking at this time frame, I wouldn't necessarily want to buy it. But look what happened. Look where that time was. On a monthly chart, the stock had just gotten above the highs from late 1999. So this was a lengthy, longer-term breakout that was really important, and really, for those that look at these long-term charts, you have to use this kind of stuff. When stocks break these longer-term highs that haven't been visited in 5, 10, 15 years, and in this case, almost 20 years, oftentimes they do tend to result in acceleration, regardless of what the fundamental news is. And I haven't studied the day-to-day on Microsoft, but I knew where that $60 level was, and when it was exceeded, it's right to buy with 2 fists, and you really jump in and you buy the stock and you hold on. It gained 50% since that breakout, really, in a short period of time, which is just a little over a year. So regardless of what all the noise said, utilizing longer-term charts can help to aid you technically and hopefully help you be a little bit more profitable in what you're doing. JC, we'll go back to the yield chart and what you talked about. Will yields hurt technology? I look at this yield chart from going back since 2014. To me, this is an important breakout. So yields have gotten a little bit stretched in the short run. Personally, I look at things on a very short-term time frame, so I'm looking at yields potentially peaking at between 268 and 275 over the next week and a half and starting to see a pullback in yield. But is it right to really think that's going to extend? I think the answer to that is no, only because this longer-term weekly chart suggests that yields have made a meaningful breakout of the move since 2014. Gundlach tended to think that the longer-term trend for treasuries yields had been broken and that the new bear market for treasuries has begun. It's early for me to make that call. Now, just looking at the trend channel, I know that yields obviously peaked back in 81, and we've had a longer-term trend in place since then. But I think the channels are very important, particularly since this has happened and it's been so symmetrical since the late 80s. This is an exact 30-year trend. This shows the highs of this trend to be right near 305. So for me, that's right at the peak of January 2014 when yields hit 305. It's going to take a move over that to really make me think that yields are in fact breaking out and we can see meaningful movement higher in treasury yields. What should that be good or bad for? Well, I think immediately you'd think that it's going to be bad for the utilities, it'll be bad for the REITs, it'll be bad for the telecoms, and that likely could be bullish for the financials. But I mean, obviously, and I'll get to that in a minute. We'll take a look now at multi-asset analysis quickly. This is also something for those that only look at stocks, and many people just say, well, yeah, I look at tech stocks and that's it, or I look at financials. Well, you have to take a look at what's happening with other asset classes. They really do help to aid in your analysis. In this case, you look at what's going on with gold, the dollar, and the 10-year yield. It looks pretty choppy and messy on the left hand, but you can see pretty pronounced periods of where, you know, all of a sudden yields peak and start to pull back, and the dollar pulls back also, and that's been very good for gold. Gold shown in blue, the yields are shown in white, and the orange is the dollar. So you see recently, you know, going back since last September, both yields and the dollar started to really begin to rally substantially, and ever since then you saw the minor pullback in gold. Well, that bottomed in December, and all of a sudden you saw the dollar really start to deteriorate very quickly, and gold all of a sudden took off. And so it's important to really keep that in mind. Here's a chart that looks just at commodities and the dollars. We all know commodities are priced in US dollars, and so when you start to see, if you have an analysis of the dollar, that can help you. Well, for those that look at long-term cycles of the dollar peaked in December of 2016. My thinking is that was a 16-year cycle, or 2 cycles of 8. It peaked also in 2000, 2001, and it peaked in 1985. So the euro should have really bottomed late last year and likely has 6 to 7 years of higher prices for the euro. That doesn't mean it's going to be a straight line, and right now sentiment is higher than it's ever been on the euro. But technically, and even based on DeMark and other counts, it looks like the dollar has another 2 to 4 weeks of downside, which means the euro still has upside, and it means that likely, you know, that we see further rallies in commodities. Commodities is one of the big themes for this year for myself and for a lot of people, given that I do think the dollar decline has been meaningful, and I think that likely extends on an intermediate term basis. Treasury yields and financials. Many people after QE don't realize the extent to which these have correlated. It's gotten up to right around 0.55 when you look at the R. So it's different than over time. Over time, it's been about a 0.23. And so in general, ever since QE started, you start to see the yield movement. We saw a big movement down in yields and financials, and you've seen recently yields push up and financials have begun to accelerate. So the 10-year yield actually has been more highly correlated with financials than the 2-year or with the 2s, 10s. So it's important to take a look at that. Here's the dollar and commodities. You see the peak out in the dollar early last year. That's almost precisely when commodities started to bottom. We saw the peak initially in 2016. Commodities made a long-term bottom after 5 years down. Then they went sideways for 2 years. Now they're finally starting to emerge. So if we get above these highs in 2016, 17, that could be really bullish for commodities. And my thinking is that can happen. It's happened with the energy. It's happened with the base metals. Now we're finally starting to see precious metals participate. And my thinking is if the La Nina is good on the obviously in causing the cooler waters, and that's not necessarily confirmed yet, but we're starting to see signs that that could affect the grain market as well. Technically, it's probably a little bit early to be real bullish on the grains. They've been pretty choppy, but it's something I'm watching carefully. But I do think the space in general can start to have a couple good years, and I like being long commodities. Here's the Bloomberg Dollar Index, and this is what I like to look at versus the Dixie. The DXY has about 63% against the euro. This only has about 32%. So it's a better reflector of the US dollar index than really the DXY. This broke down. I do have some DeMark counts. As you can see, they gave a high in the early part of 2017 and a low right near September. That rally lasted only about 2 months, and then it made a more meaningful breakdown. So this is what many people would refer to as a head and shoulders, or whatever you want to call it. It's a fairly bearish formation, and now we've broken under the lows from last fall. So from a DeMark perspective, and by DeMark perspective, I mean my reading on DeMark, we have about another 3 or 4 weeks where this would line up with what people would refer to as a 9-13-9 pattern, which on a weekly basis likely could coincide with a little bit of stabilization in the dollar. That means the euro might peak. My think is the euro gets to 126, 126.50. But initially, the dollar still looks to have downside. So I'm long the FXC and the euro. I still think we have more upside. I think the dollar moves down, and that should, in fact, also be bullish for commodities. Here's a CCI index, and you see as an equal weighted CCI breaking out of this longer-term downtrend. getting above these highs from 2016 and 2017 highs are really going to be important to really helping this provide a little bit more acceleration, and that would help to get it up right near 500. Big move for now. Still a little bit early. Continuing on quickly, Treasury yields breaking out. So why is it important to look at Treasury yields? Who cares, right? Well, a lot of people, even if you're involved with equities, need to know the trend of yields. If you see the breakout, it bottomed out in September. Well, look at what groups peaked between September and November of last year when yields started to accelerate. Well, the REITs did, for one. You thought that was a breakout back end of September of last year, 2017. That turned out to be false. That was a false move. Why? Well, yields started to turn up dramatically. This group plunged and has actually broken a longer-term area of support, and so that is interesting, and if anything, makes you still want to avoid the REITs. Meanwhile, the utilities peaked out late last year, also yield-related. So the Utes are one to avoid. Look what happened over the last couple weeks. This is just utilities where that arrow is pointing. They're starting to stabilize a bit. That means that yields potentially could be near a peak, and or the stock market as a whole. When you start to see thin breadth and these defensive sectors start to outperform dramatically all of a sudden, like you've seen from extended levels on the downside, that oftentimes can be a warning sign. So I think it's right to be long the utilities. I think that yields in the short run peak near 270 and pull back, and I think, if anything, that provides at least a meaningful bounce in these defensive groups, which likely takes place between the end of January throughout February, and that also could coincide at least with the end of hibernation, so to speak, but it probably will prove temporary as we all know it. Summary, utilizing relative charts. So obviously this is important, and you guys, I'm happy to send you copies of this presentation, but it's great to look at stocks that are strengthening or weakening versus the sectors, subsector shifts, attractive risk-reward opportunities. They're really essential for really spotting that sector rotation that really is prevalent. And many people would really do themselves a world of good by starting to employ these on more so than they do. Time frame analysis. So as I mentioned, is it right to buy or sell a stock in the short term? Maybe yes, maybe no. All the indicators in the world might say to sell it, but if you look at a longer term chart and it's just broken out, then typically any sort of consolidation is going to prove temporary and it's going to continue. Finally, multi-asset analysis. So what sectors are going to outperform, underperform? It's good to look at the dollar. It's good to look at treasuries. It's good to look at commodities. These can help you to see that, okay, materials are going to outperform. Energy is going to outperform. Treasury yields are moving up rapidly, so the Utes likely are not going to do all that well on an intermediate term basis. Neither are the REITs, neither are telecom. Those are all important and oftentimes can be useful in terms of being tools. So for those that don't know, I used to work, as I said, at Morgan Stanley, Diamondback. I opened my own shop about a year and a half ago. I provide technical analysis to institutions and to retail. I'll give you my contact info. I oftentimes put out at least a piece every Monday through Friday, as well as I do videos every morning, 5-minute videos, what's the most important charts that you need going forward. I would do conference calls every week, and I do weekly pieces, and usually 2 reports every day. And yes, I'm just a one-man show, so I do it all. This is my contact info, and I'd welcome those to email me, or you can visit my website. I will extend a trial to those that want. For any that sign up and are subscribers between now and the end of January, I'm willing to knock off half the cost for retail. For those that are institutions, I can set up a program where I can start to help you in really managing risk and try to add alpha to your portfolio management process, because that's what I do. I look at charts, I write up charts and deal with a lot of institutions. I give long and short candidates for those that are looking for that kind of thing, and I try to give a lot of market flavor. So I hope you'll join me. That's all. Thanks for having me on, JC.
Mark, I don't even know where to start. That was so awesome. I think you bring a unique perspective with all of the relative sort of all of the ratios, right? And a lot of these things, you and I have been doing this for a long time, so I think we take it for granted. Some of the questions coming in were like, well, where can I see a list of these relative charts? And some of my answers were, it's really an unlimited list. I mean, you can go on forever, comparing subsectors in the industries to the sectors themselves, asset classes versus each other, different country's indexes versus another. So, I mean, that's my take on it. It's just an unlimited amount. Do you want to touch on maybe how you approach that question?
Yeah, it's taken me a few years to develop all these relative charts, and it really is important, I think, whether you look at a certain sector or look at, asset class versus asset class. But, the more signals you get, the more accurate you can likely be in terms of your timing. And so when you combine time frame analysis with relative analysis, it really is helpful in terms of pinpointing that, okay, is it right to be long financials here? Well, all of a sudden, if utilities are starting to bottom and yields are peaking out, and I look at ratios of different things that might suggest financials are going to fall, then it just helps to put things in perspective. And so you really gain a lot from that. So I'm happy to work with anybody that needs help and provide any sort of charts that might be helpful to those that are looking.
Awesome, Mark. I think what you did today was fantastic. I think between all of the different presenters, there's a ton of talent here today. I think what you bring really complements a lot of that. I know we've had some relative ratios. I know I will certainly talk about them this afternoon, but you really dove into it, and I love it. It's such a great topic. It really is such a great topic and such an important piece of the puzzle, and you just completely focused on that, and I think that that's just so valuable. I didn't realize that you were going to do that when you told me, but I'm so happy that you did.
Well, there's 1,000 ways to skin a cat, as we all know. We each bring a different piece of valuable analysis to the table, and so I obviously don't pretend to think I know it all. I learn every day, and I value analysis of people like yourself and there are other presenters that are on the panel today, and I look forward to working with you all in the future. So I really thank you for having me, and look forward to working with any of you. Welcome the opportunity going forward.
And for you guys, make sure Mark Newton on Twitter and everything. Great follow, great content, always really smart guy. So Mark, beers on me next time I'm in New York, I promise.
I'm going to take you up on that. Thank you very much. Happy New Year. Take care.